Good afternoon, everyone, and welcome. My name is Kurt, and I'll be your presenter today. A little bit of housekeeping, a little bit background information before we get into the meat of the presentation. Everyone's muted, everyone's cameras turned off. Slides are available upon request. You can get a recording of this as well if you'd like. Shoot me an email. I'll have my email on one of the slides. I want to thank you all for signing up to learn more about your TSP and how to avoid some of the most common mistakes that we see. I'll be using your retirement plan names interchangeably. TSP, 403B, 401k, IRA, all generally work the same way, all retirement plans. A special thanks to those of you who've attended our presentations before. We've been doing this for over 5 years now. And what you're about to hear, it represents the best and the brightest thinking from our team here at Turning Point Financial. It's the collective wisdom of over 100 years experience. Next, a little bit about me and my background. Again, I'm Kurt LaLomia. My firm is Turning Point Financial. I'm a financial advisor, and I specialize with federal employees. You see that with the designation Chartered Federal Employee Benefits Consultant. I know your benefits well. I started my career on Wall Street over 30 years ago, and I spent much of it in legal and compliance departments. Compliance is the reason that I moved to the advising side of the business. Many advisors I supervised, they weren't doing things the right way, and I wanted to make a difference. My firm, Turning Point Financial, we're a fully registered investment advisory firm. The SEC is our regulator. Our home office is in Frederick, Maryland. We work with federal employees from most agencies across the entire country. We're fiduciaries. That means we're required by law to put our clients' best interests first. We get asked this every day, and it's important. If you're looking for an advisor, this is a question you must ask, because not every advisor out there is a fiduciary and held to the fiduciary standard. Our website, tpfinancial.com. You can learn more about the different services highlighted on the screen. Many of our clients enjoy the benefits of one-stop shopping. And it's our tax department that's the fastest growing area of our business. And helping people lower their tax bill has become an expertise of ours. I'll be hosting a tax planning webinar in October, and we'll be sending you information about that. One more thing, if you haven't picked up on it already, or if you haven't attended before, take my responsibility as an advisor serious, and sometimes I come across in a serious and straightforward manner. That's my passion. And I'm going to do my best to keep things light and engaging with some good stories that we can all relate to. Here's a look at our webinar calendar, what we've done and what's coming up next month. All of these are recorded. We have replays. Shoot me an email if you'd like a copy of the recording, a copy of the slides. I'm happy to share those. Today's presentation is educational. It's not a sales pitch, and I'm not here to sell you anything. We will have Q&A at the end, and your participation today, that entitles you to a free meeting with me. If that's something you're interested in, I'll tell you how that works at the end of the presentation. Here's a look at how we have the presentation unfolding. I'm going to talk for about 25 minutes. The biggest mistakes that we see, they're costing folks a lot of money, and that's likely why many of you are here today. Let's look at it. Here's the most common mistakes in retirement plans that we'll be getting into today. Not being in it, not participating, not capturing the free money, the match. Sounds surprising, but it's surprisingly common. Not having your money going into the Roth, having outdated beneficiaries or no beneficiaries at all is a major mistake and common. If you maxing out too early in the year is a problem. We'll talk about that and tell you why. It's great to max out, but you got to do it the right way. Taking a loan from your retirement plan is almost always a bad idea. When you take money out of your retirement accounts, you got to be smart about it. You got to know the rules. You got to be tax efficient. We'll tackle that. Trading your TSP or your 401k, your 403b, never a good idea. And we'll talk about timing the market. And then the rollover. We'll be talking about why it's important to roll over your workplace retirement plan when you leave service or change jobs. I want to start with some very basic information. Most of you already know this. If you don't, you should. It changes every so often, so it's good to revisit it. Maximum contributions for your TSP, your 401k, and your 403b for 2024 is $23,500, and that's if you're under age 50. If you're over 50, then you can put in up to $30,500. These amounts are set by the federal government. They do change every couple of years. You can contribute to both your 401k, your TSP, and an IRA. And the maximum contribution limits for IRAs are $7,000 for younger folks, $8,000 for older folks. This is a common question. That's why I bring it up. Again, you can contribute to your work plan and your IRA. If you're an aggressive retirement saver, you might consider doing both as long as it fits your budget. Why would you do both? You do both because you can do something different in your IRA, which will complement your TSP or your 401k. The 5 TSP funds, they're broad-based. They invest in different industries, different size companies. Maybe you want to do something a little more targeted or specific, and that's what the IRA allows you to do. That might be something like a healthcare fund, a technology fund, an energy fund. These are just examples and not recommendations. Something that I like to do with my clients is to have them put their IRA money into our proprietary 80/20 portfolio. It allows folks to diversify further and capture opportunities that aren't available in their work plan, opportunities in India with gold and infrastructure strategies. Mistakes, they can occur when we make emotional decisions, and that happens to all of us. We're going to address that. We're going to tell you how to avoid that. Advice, let's face it, we all need a trusted partner in various areas of our life. That could be a work colleague, a parent, a sibling, a financial advisor. We'll be getting into that. Let's rip through a few more basics. I want to talk about money in, money out. Sometimes asset location is a terminology we like to use in the industry. That refers to where your assets are located. Is it Roth? Is it traditional? Retirement, non-retirement, your emergency fund. Having the right amounts in the right type of accounts for a specific purpose, that matters. We don't want to have home down payment savings or car money or education money in our retirement accounts. That goes somewhere else. So it's important to prioritize where you're saving and how much you're saving. When we take money out of our retirement accounts, you can do that in a lot of places online today. Death and divorce situations or circumstances where paperwork is going to be required. It's important to get this right. If you don't get this right, there's a good chance you're going to get whacked. And that's whacked with taxes and whacked with fees. Recently, I learned of a circumstance where an individual was attempting to roll over their TSP to an IRA, and they didn't know what they were doing. And they made a big mistake. They got a $400,000 check at home. It was payable to them. And in the check stub, $100,000 had been paid to the IRS. This person was not paying attention. They did not get advice. And now they have a very big problem. It's a big problem because that $400,000 is added to their income, which will push them into the highest federal tax bracket, 37%. This could have been handled differently had this person sought some advice. The tax bill could have been minimized or deferred at the very least. There is a silver lining and some good news. Our tax team here at Turning Point will help them sort this out when they file their 2024 tax return next spring. I'm assuming nearly everyone or everyone with us today is participating in their TSP and their 401k and capturing some or all of the generous 5% match. If you're not, you're leaving money on the table. Roth and traditional, we have a lot to say about that coming up. Work, your work plan, that refers to TSP, 401k, 403b, 457 is another. Again, they all function the same. Saving at home, that's on your own in an IRA. Maybe you do that with an advisor. Maybe you're doing that on your own. TSP limited to 5 funds and various L or life cycle funds. We're going to get into those. So let's keep going. Not participating and missing the match. Believe it or not, this is a common mistake. It shouldn't be, but it is. The TSP is the fastest, easiest way to save and accumulate wealth because of the match, because of automation, because of the fund choices. It's automated and invisible with payroll deductions, matched up to 5%. That's free money. It also offers immediate tax benefits by lowering your taxable income. That would be traditional TSP contributions. It's a no-brainer. This should not be a mistake, but it is. So I feel compelled to call anyone out that's not in this game. Your TSP will likely become your largest asset. So it's important to evaluate how that fits into your entire plan. What does that mean? Here's some questions to consider. What does your retirement look like? If you're married, talk to your spouse about what you envision your day in the life of retirement looking like. What's your plan to stay engaged? And what are you retiring to? How much money do you need to have in your TSP at retirement? And let me tell you, there's no magic number. Everyone's number is different. Depends on so many things. That's a whole other topic, and we've done dedicated retirement planning webinars. Happy to share those with you. What amount of risk are you comfortable with? It's one factor you should be using to select your funds and your allocation. How about your annual contributions? How much do you need to put in? What rate of growth do you need to reach your goals? You need to effectively plan your TSP if you want to be able to retire. There's no one-size-fits-all solution or boilerplate retirement planning. Please make sure you're getting some good advice, and I'm not talking about just water cooler advice. My advice at a high level, start early and with any amount. I'm pounding the table with 5%, capturing all the 5%, but if that doesn't fit your budget, that's okay. It will one day. Start at 1% and bump it up over time. There's plenty of time to catch up. Let's just leave it on autopilot and let it grow. You need to be disciplined. You need to have a strategy that gives you the opportunity to build a fortune, control your future, manage any uncertainty that you may have with Social Security or your pension or anything else. Strive to max out. What's that? That's the contribution limits we touched on earlier. Everyone should be striving to max out. Lastly, use your resources. TSP, 401k providers like Empower and Principal, they have great websites, they have webinars. They've come a long way in recent years. Diversification is next. What do we have going on here? What's all this about? Talking about how much risk you're taking. And that should lead you to think about how comfortable you are with risk. What does all this mean? I'm referring to what funds you own. As I said, TSP has 5 funds. CS and I are growth. F and G are not. Let's use an example. If you're all in on the stock market and you're comfortable with risk, then you'd want to own only CS and I, or an L fund that's far out in the future, like 2065. On the other hand, if big losses in the value of your TSP are causing you to lose sleep and impacting your health, you're taking too much risk and you ought to dial it back. Diversification, it impacts what we're talking about here. It's what you own in your TSP, how much, and how much you're contributing to the different funds. An example of over diversification would be owning everything available in your TSP with no strategy. Under diversification, that's the opposite. That's taking too much risk or too little risk. An example would be owning just one or two funds without a strategy. L funds or target date funds, they have a strategy. And I know that's what many of you do, and it's a great place to start. We all need to be managing risk, maintaining balance, staying ahead of inflation by taking the right amount of risk, all with the objective of achieving our unique goals. How do we do that? You're educating yourself by coming to events like this one. You're going to the TSP website. You're attending TSP webinars. Maybe you're working with an advisor. You create a plan and you execute that plan. Doing this or not doing this, that's going to determine how much you'll accumulate and whether you'll achieve those goals. I want to talk about the G fund next. That's one of the 5 index funds offered in your TSP. It is invested only in US government securities. People love it. It's attractive because it offers the lowest volatility. That means it's not moving around a lot. It's guaranteed interest. There's little to no chance of losing money. All that's true, but the long-term performance of the G fund is not very good. Someone who chooses to invest in a more diversified manner is going to fare much better over the long term, after inflation, after taxes. What does that mean? Let's look at an example. Someone we worked with around the time of the great financial crisis of 2008. This person became extremely conservative with their investment strategy. They were afraid of losing their entire nest egg. A lot of us have been there. So this individual moved everything to the G fund, and all future contributions went to the G fund. And over the course of their career, they earned 2.3% annually. TSP grew to be over $600,000, a handsome sum of money. Had this person thought about things a little differently, diversified some, and invested 60% in C, 40% in G, they would have seen a blended return of 8.8%. Their decision to stay in G, it resulted in their TSP earning less than inflation, and their account with diversification could have grown to well over $1 million. One other thing, you and your coworker, you may both want to retire in 2030, but does your retirement look the same? I doubt it. Make sure you have someone helping you out with this stuff. We're going to get into beneficiaries. That's who gets your money. It stands alone. It does not follow your will. Your beneficiary designation on your TSP, your 401k, your life insurance, whoever's name you have on that, that's who's getting the money, not what your will says. This is another area. It should not be a mistake. But I bring it up because there are a large percentage of TSPs and 401ks and IRAs without beneficiaries designated. And if you don't do that, you leave it to chance. Someone else is going to decide who gets your money. And make sure they're up to date. If you've had a life event where you've gotten married or gotten divorced or something else has happened, have a look. Make sure it's up to date. You can change the beneficiary online in most places today. Those of you that max out, you need to be contributing over the entire calendar year, all 12 months. Spread out those contributions among the 26 pay periods. That will allow you to capture the ups and downs throughout the year. In other words, if you're maxing out, don't do it too early in the year. We are in what is typically the most volatile time of the year in the stock market, and it's a great time to be an investor. because you're buying the market on sale. Those of you that pay close attention to this, you know what I'm talking about. Just look at last week, a little mini correction. Market was on sale. Would have been a great time to be doing your dollar cost averaging in your TSP, your 401k, however you do it. Overlapping investments. We already touched on that briefly. Your IRA, your TSP. We don't want those invested in the same thing. Pick a theme or a sector that you feel strongly about. What is all this about? Why does this matter? To effectively plan your retirement, we have to coordinate your TSP with your IRA along with the non-retirement accounts. Make sure everything's working in harmony to help you achieve your goals. We need coordination among all your assets to create strategies, balance, little or no overlapping investments. Your money has a purpose, and so should every account. Your TSP is valuable, your 401k is valuable, your 403b is valuable, but those should not be your only investment accounts. Here's an example of what I'm talking about, having a complementing investment in your IRA. A complementing investment is going to give us exposure to other areas of the market not currently available in a TSP or a 401k. Owning real estate, energy, technology, those are examples of how you might go about this. Put those in your IRA. Again, these are not recommendations, just examples. If you've heard me talk before, you know I feel strongly about the Roth, and everyone here today should have some of their contributions going into their Roth account. You're paying the taxes now in exchange for not having to pay taxes later. Taxes are expected to be higher in the future, and we all get our first taste of that in 2026 when the current tax code expires at the end of next year. For the younger folks participating today, that tax-free growth you get from the Roth, that will greatly benefit you. Think about your smaller contributions that grow to become very large sums over your career. You paid tax on the smaller contributions. Your money's grown tax-free, and it's going to come out tax-free. Let's look at an example. You contribute $100,000 to your TSP Roth over the course of your career. That 100,000 has grown to over $1 million. We paid tax on $100,000, and now you have $1 million tax-free. Compare that to the same person with $1 million in their traditional TSP. They're going to owe taxes at current tax rates on the $1 million. What sounds better to you? Taxes on 100,000 or taxes on $1 million? How you get money out of retirement accounts without penalties, fees, and taxes, it comes down to knowing the rules, knowing what you're doing. Have someone help you. Make sure you're getting good advice. Attend events like these. Learn the rules. TSP webinars are excellent. Their website's excellent. The call center, they're all good resources. If you're using an advisor, make sure they're well-versed with the TSP rules. An example of just how expensive a mistake can be. If you miss a required minimum distribution, the penalty is 25%. Loans from retirement accounts are generally a bad idea. Loans stunt your retirement savings, and it may cause you to work longer. It creates a problem if you leave. You have to pay that loan back immediately. You must consider the big picture when you're taking money out of your retirement accounts, TSP, 401k, IRA, and I'm referring to traditional accounts. Taxes matter, your withdrawals. When you take money out, a withdrawal, that's added to your other sources of taxable income, your pension, your Social Security, your part-time income, your spouse's income. Maybe you have rental income. Make sure you know what you're doing and talking to someone about this before you begin taking money from retirement accounts, because being tax efficient is a big deal. Oftentimes we're asked, what's the right order? What account should I take my money from first? What does that mean? Well, you may have Roth and traditional IRAs, a bank account, a TSP, an investment account. Where do you take the money from first? This is where the value of advice really matters. We need to maintain growth in your accounts and be tax efficient. And a withdrawal strategy is the answer. That's something we create with the people we work with by having a grasp of their big picture. That's usually accomplished with a financial plan. There's a 10% penalty if you're taking money out of retirement accounts prior to age 59 and a half. Plus, you owe the taxes. If you have extenuating circumstances and you need to do that, then you do it. Otherwise, it should be avoided. Regarding rollovers, IRAs provide more flexibility, more options, and greater control. They often come with valuable advice. I have a dedicated rollover slide coming up. Trading your TSP is a very big mistake. Retirement accounts are meant to be set it and forget it type of accounts with an annual rebalance, meaning you make your contributions, you let it grow over time. Panicking, moving it all to the G fund, that's a very big and very expensive mistake we hear about often. Timing the market, which is what you're doing when you make the decision to go to the G fund with all of your growth funds, it's a bad idea. It's a bad idea because it requires you to be right twice. First, when to get out. Second, when to get back in. That, my friends, is nearly impossible. It's time in the market that matters, not timing the market. Human nature sometimes gets the best of all of us. We make emotional, irrational decisions that can be a big mistake. Panicking is loss of faith in the future. The world does not end. It only appears to be ending. And all market declines are temporary. All market declines are temporary because the market is propelled by the economy which it reflects. And our US economy is permanently rising. Our human emotions guide and influence behavior. We all have an emotional human nature. And oftentimes we can be our own worst enemy. We need protection from ourselves. We need someone to help us stick to our strategy, act as a sounding board, and maintain discipline. That's one of the main reasons my clients have hired me. I'm their coach. What does all this mean? Statistically, 1.5% to 6% is lost every year by the typical do-it-yourselfer that makes bad decisions because of their emotions. They panic. They make the big mistake. They sell their CS and I funds and they move everything to G because they're caught up in the noise. As I said earlier, you and your coworker, you may both want to retire in the same year, but it's unlikely your retirements look the same. Do not panic after a bad month or a bad quarter. 90% of long-term portfolio performance, it's based on 3 principles: faith in the future, patience, and discipline. The other 10% may be tied to security selection and timing. If you're just getting started, I suggest one of the L funds. L stands for life cycle or target date funds, and use a date that is near your retirement date. The L funds are comprised of the 5 TSP funds, C, S, I, F, and G. They're rebalancing automatically every quarter. They get a little bit more conservative as we get closer to that target year. I don't like to see people owning multiple L funds or L funds and individual funds. creates unnecessary overlap. It makes it difficult to get a good idea of your overall asset allocation. Taking too little risk if you're young and just starting your career, that can be a mistake. This may cause you to think about choosing your own funds. The growth funds I mentioned, that might be appropriate. We like and recommend having exposure to both Roth and traditional in your TSP because we don't know the future of taxes. And having two strategies, that's going to help you manage that uncertainty. Rolling over your TSP, your 401k, your 403b, rolling those over to an IRA is what most people do because it makes sense for a lot of reasons. In fact, we have our clients often do it before retirement because it helps with their retirement preparation. You can do it as early as age 59 and a half, or you can do it if you leave service. You'll get professional advice and guidance, thereby lowering the risk of you making a costly mistake. There's vastly more investment choices, and these choices are tailored to your individual needs. TSP is terrific for accumulating wealth. It's not very good for distributing wealth. It's built for the masses. It's not built for you. Roth conversion, some of you know what that is. That's a tax strategy only available in IRAs and not something allowed in a TSP or a 401k. Our clients are taking advantage of today's historic low tax rates with Roth conversion strategies that we guide them through. We're not going to get into that today. We have dedicated webinars on retirement planning, Roth conversions. We'll likely talk about it next month in our tax planning webinar. It fits there. RMDs, or required minimum distributions, those are also a big deal, and we don't have time to get into that today. But rolling over your TSP and working with an advisor, you're going to get some advice on how to manage those required minimum distributions. I put fees on the slide here. We're transparent about that at my firm. That's how I get paid. People pay me for advice, and that advice usually helps them avoid a lot of headaches. It saves a lot in taxes, and it may offer greater returns on their money. The value of what we offer in the form of advice and service vastly outweighs what our fees are. Today's takeaways. Here's everything we talked about. Again, slides available upon request. Send me an email. I'm happy to share the slides or a copy of today's recording or any of our webinars. The biggest mistake we see people make is not asking for help when they really need it. Fortunately, you have resources. Several federal agencies, they've asked me to be a resource to you. Please contact me if you need help, if you have questions about anything we discussed today. Use my contact information on the screen. You can learn more about me and my firm on our website, tpfinancial.com. You can also connect with me on LinkedIn. I'm already connected with many of you. Early on, I mentioned the free meeting. Your participation today entitles you to a free meeting with me. We can talk about this stuff in greater detail. We can talk about other issues that are troubling you in your financial life and get your questions answered. Send me an email if you're interested in the free consult, and we will get a time scheduled to do that. We can meet over the phone. We can meet on Teams. If you're in the Frederick area and would like to come to the office, I'm happy to have you in our office and we can meet face to face. So that's it, folks. I want to thank you for being here today. Appreciate your time. And if there's anything we can do, please get in touch by email or by phone. My full contact information is on there. Look forward to seeing you And I hope to see you again next month when we're back with tax planning and election webinar. We'll be sending you information about that as well as registration. Thank you so much. Have a great day.